Okay.
Okay, so there's millions of brokers. A brokerage is just the trading platform for any sort. So there's millions of brokers, and people can trade on them on their trading exchange. Data is coming from this source called ICE, the ICE exchange. So what this is uh, the original trader. Let's say there's on day one. Let's say trading doesn't exist right now. There's one guy who has to do transactions with someone else in order to keep prices stable in their country for the future. Because imagine right now you're a cattle farmer and you have to sell cattle in 6 months to a guy, but he wants the price that it is today. In 6 months, the price might be like 30% higher or lower. So now he doesn't want to put that risk up, right? Okay. So in order to keep that guaranteed, they invented trading, the act of transacting currencies, or in this case, product, for the future guaranteed delivery of that price today. Okay. So if he's selling cattle, I want to buy it for $100. We will lock in $100 today, and if in 3 months when it's due, the price is up at say $130, I'm going to get today's price that I agreed on today, not 30 that day. So what does that mean? I saved 30% that I can now sell to someone else. Because now when I deliver the cattle, I save 30%, right? That remaining, I can sell at a higher price to that new guy. Okay. And now you've created this network of these guys who are buying and selling. Okay. And that keeps prices stable. Otherwise, today the US currency would just go to like 1 million. That's what's happening in cryptocurrency. Yeah. So you know how in crypto prices just bounce like crazy? Yeah. Because there's no one regulating them. Like there's buyers and sellers just moving billions of dollars, and there's no one to be like, today's price is the price you're going to get. It's whatever price you're given, because the community is decentralized, meaning that it's totally public. So there's no one to regulate you and be like, no, sir, you're getting today's price. Right? Does that make sense?
Yeah.
And before the 1980s, they would just do that manually. They'd write down the price and deliver it at the stock exchange. You know, like that running place, the pit? Yeah. The pit trading, like this place where people are screaming. Yeah. Yeah. So the reason they did that was because there was no stock chart and instant price delivery on all these data servers we have now. So then ICE came along and took all that stuff together and created ICE Exchange, which is where they give you the data and they pay millions of dollars to give you that data. Like
so does ICE only have like foreign exchange markets?
No, ICE has everything, including like corn, cattle, coffee, like everything.
Do they have crypto as well?
Yeah, they have literally everything. And it's called clearing. So clearing is where they give you the brokers to collect the data from. So ICE, who is at this data center, the ICE Exchange data center will, this is ICE Exchange building. So at this building, they have like all these data centers around the world, and from here it's being broadcast to different clearinghouses, which are brokers.
Okay.
So that's where the pyramid begins. So the ICE Exchange is delivering the data to brokers. Clearing, and then clearing is giving it to the brokers. So what's happening is that ICE is giving data to these guys. These guys are guaranteed giving the data to brokers, and then based on the trades, they'll pay out traders. So there's this middleman between ICE and the broker, which is the clearinghouse, who is just your guaranteed delivery guy. Okay. And in blockchain cryptocurrency, this doesn't exist. You could say it's just directly blockchain, and it goes direct to the brokers. So they cut out the ICE because it's just blockchain direct.
Okay.
And now what's happening is they're just sending data to brokers. And now the bank will come in as the head guy above all of them and just agree to give money to the brokers for whatever rate. Like the bank will be like, so the feds will come out and say, so this year we're releasing 20,000 in treasury notes. And then the bank, they'll give those at a price to the bank. Okay. So it's literally just someone printed money and gave that money to the brokers
Okay.
for a discount, and they got that little like 1% on that. But 1% of like 20 trillion, like yeah. So that's where money comes from. So the money is coming from the feds who are sending it to the brokers, and the brokers are interacting with the ICE exchange, who's giving data.
Okay.
And that's trading. Like when you look at a chart and you're like, where are these lines coming from? It's literally just the ICE exchange delivering the data to the middlemen brokers who are giving us, the traders, the data to trade on, to do buy and sell orders based on the guaranteed price delivery. And the guaranteed price delivery is called arbitrage. People love to use this word because it sounds like a movie, but it just means guaranteed price delivery.
Okay.
Yeah, that's all it means. They're gonna like write a lot about it, but it just means that whatever price I set is the price you're gonna get, and it's not gonna be some other price. So this is just arbitrage of candlesticks of prices. So prices are moving up and down from ICE, and then traders are betting on the direction of that using buy and sell trades.
But as of right now, crypto isn't moving that way, right? Through ICE.
Yeah, the crypto is coming directly from blockchain because it's public. Yeah. So the reason that people go through ICE is because farming, coffee, beans, everything is regulated with the banks and private companies. But crypto is just blockchain. You can just wake up, and the reason that you're getting a coin is because everyone agrees that that coin exists. Oh, these guys, it's that the government agrees it exists. Yeah. So that's why everyone's all big about that, because it's totally public.
Without government involvement.
Yeah, without anyone being, yeah. So it's totally for the people, by the people type of thinking. And those lines, again, are just moving up and down of prices. And you can change the period to like 1 hour, 4 hour, 1 day, 1 month of the ranges you want to see of that price to give you a better prediction of whatever you're analyzing, whichever market you're going to analyze. And then you press buy and sell on that. If you're buying, you want it to go up, which you'll make money on the difference. And if you're selling, you'll make money when it goes down based on that difference. And if it does the opposite of your order, you're going to lose money. So it's as simple as when you buy, let's say we bought at price 100 and it went up to price 120 and I sold, I just made $20 because I bought it for 100 and I sold it for 120. That's $20 profit. But if I bought it for 100 and it went down to 80, I just lost it $20 because I bought it for 100 and I sold it for 80.
So when you're selling, you want it to go down?
Yeah, exactly.
Can you explain how shorting works?
Oh, so shorting is borrowing money from the bank. So the reason that people make money on the sell short is because they're borrowing that asset from the bank, which is where they bring up that whole thing about leverage. Leverage, again, is just another, like people love to use that word, but it just means that you're borrowing funds from the bank who is guaranteeing that you have this borrow rate to sell based on the fact that you want it to go down. So you're selling something that you borrowed for a guaranteed delivery of the price.
Okay.
Which is just another way of saying you're taking a loan without interest temporarily.
So it's like if I borrow this cup from you, and right now it's worth like $100, right?
Yeah.
And then I short it, or then the price goes down. I technically just have to give you the cup back, right?
Yeah.
And whatever the difference of the price is, I keep that.
Yeah, you keep that because the trader who lost money on that trade paid out for your profit somewhere in the world. Whoever was the guy that bought it. Yeah. Because the only reason I can loan it to you is because this guy is buying it from me too. And he's probably buying it at a higher price. So I don't mind letting someone else borrow it to sell it. Oh, and I get a commission on your sell, so I'm inclined to give it to you.
Okay.
So the reason that they include sell is because they want, again, prices to stay stable. And selling only exists in this type of market. It does not exist in actually buying stocks, because stocks you can only buy because you're buying into the actual company. Like if right now I bought Google stock, I'm buying a share in the actual company. So I'm actually going to pay 1,291 for the share of Google. But in Forex, futures, crypto, whatever you want to call it, that goes through a clearinghouse.
Yeah.
That's just for cash. That's just for cash delivery. So this price of 1.1, I'm not actually paying 1.1. I'm paying whatever I risk.
Yeah.
And I'll be guaranteed that amount when I trade it. And the reason they do that is it's called a derivative. This again, people have using this word, derivative. Very simply, it's just the underlying of whatever you're saying. Like if I say the derivative of Honda could be like whatever company is like the one that Honda owns. Or like the derivative of Google is Alphabet because they own a company called Alphabet.
Okay.
So in this, I would just say the derivative of Euro USD is like whatever market is below that, like the sub market.
Okay.
So they do that to, again, just keep prices stable, and it's a smaller market, and it's just for cash. So it's actually just a quick way for brokers to make money. This is basically the reason they made that. Because in the 90s, you could only trade stocks for millions of dollars. But with the invention of derivatives, they allow for cash-to-cash transaction. So you don't have to pay for the stock, you just borrow it and can take a sell on that borrowed stock.
Okay.
And it's just cash. It means that there's two guys who have money, like this guy's $1 billion, this guy's $1 billion, and then the traders between them are doing buys and sells. And yeah, I have to do it here actually. So there's clearinghouse A and clearinghouse B, and then the traders are trading between them, and these guys are guaranteeing the price delivery to each other. And then these two are making a commission, and then the traders, if they make money, will be guaranteed paid out by these guys. These guys will pay the traders.
Okay.
And the only reason for making that was so these two could get paid. So initially, these two would be like really big insurance companies from the 60s, 70s who wanted to just open up a derivatives exchange. Derivatives, you could say, is TradeStation, and another derivative is AMP Clearinghouse. So these are two brokers. So here's AMP, and then there's TradeStation, and these two are holding lots of cash, and traders will enter trades on their platform here and collect payment guaranteed because these guys guarantee it in their regulations right here. So the era or the act. So right here, the Security Act of 1974. And these. And Securities U.S. and Exchange Commission. So these are the guys that guarantee that you'll be paid for your trade.
Okay.
And then you just enter buy and sells on those trades. And now in order to make a system, that's what I talked about for an hour today. But here, look, so what you do is...
Wait, about stop loss and take profit and all that stuff.
Yeah.
Is that just buy and sell?
Yeah, but stop loss and take profit is your... so here, so let me just take a trade. So here I took an order.
Okay, I know what stop loss. Stop loss is like if it goes below what, when you buy, if it goes below what you bought or whatever, you set it to a certain number. And if it goes close to that or whatever, it stops the trade.
Yeah, so right here, I just entered a trade and it says drag to modify. So I'll drag and here's my stop loss.
Okay.
And then I'll drag above and here's my target.
Which is your take profit.
Yeah. And now if it touches either one of these, it'll cancel out and close, and that'll be the result of the cash that was lost or made.
Okay.
And the same thing happens on a sell. Let me close this. An easier way to visualize it. So this is level, oh yeah, I'll just wait till that's done. So the same thing on a sell. I just press sell there. We're in a trade, drag my stop, because now stop is above.
Yeah, stop loss is above.
And then below.
Profit is below. Okay.
And then I just right click to close it if I want to just close early.
Okay.
And then, so that's level 1 data, which is just an entry on whatever is given to me, like whatever is available. And now level 2, which is where mans like to think they have like some sort of edge, but it's actually just more headache, is right here. So new dynamic superdome. This is where it is. So GPUSD, so right here. So this is level 2 data. So it's actually, you're seeing the price move really like in depth. And here's the buy column, and here's the sell column. I can place a buy or sell at whichever price I want. And when it goes to that price, and now when it goes and touches this price, then it'll give me the order.
Okay.
And same thing on sell side, I'll like place a sell here, and I'm waiting for it to go there. And there's my order quantity.
And that's when it's going to start the trade.
Huh?
That's when it's going to start your trade, right?
Yeah, well, once it touches this price, it'll fill the order and it'll move from that entry. Okay. So let me just pretend it got filled. Like pretend it when it hit our price, it'll look like that now. So now we're in this trade. And then your profit loss will show here. Yeah, in real time it'll move. And then same way, if I want to set my stop and target, I'll just click at the zone. Oh wait. I'll do this. Yeah, there. So I sold at 67, and now I'm going to buy it back when it drops down to 58. So that means I would have made $9, because if I sold something for 67 and I bought it for 58, yeah, that's $9 profit.
Yeah. Okay.
It's just doing the opposite, and that's level 2 market movement. Same market here, but it's giving you the option to, the ability to get the exact actual order.
But if you make this chart like a 1 minute chart, can't you still see like?
Yeah, but for like high frequency traders and guys who do a lot of volume, they want the exact actual price. Because yeah, they want the like actual exact price, because those guys are playing in like 2 or 3 pips. Like they're like in like really small ranges. So they want those little moves. Like from here to here, it could do that in like a second. So they want to like choose the exact price. And then your order quantity is the amount that you multiply your trade by. So right now it's 1,000. Let's just make it 1,000,000. And now same thing, if I enter the trade, but now it's worth, each point is worth, multiply that 1 penny by 1,000 cents, so $50. And that's how they leverage millions of dollars. So same market move, but that was the worth of that move was X amount of your leverage order quantity. And then close. And same thing is every platform has level 2. Here it's called it's called depth of market. So here's the depth. It's same thing, just uglier, and it's the same thing. Like I can click, yeah, there. See, so now my price is waiting at that at that area, or it's like waiting down here.
But in like this, I guess level 1, can't you put like a target buy in there too? Like,
oh, like place it there?
Yeah.
Yeah, so you can do that manually right here. You can choose your type and go to pending and specifically choose the price you want.
Yeah. But
this is just harder. Yeah, so there's 3 ways to do it. 1 is just enter, 2 is level 2, and the 3rd one is this one where you select your actual, like you type it in.
Level 2 is just easier, simpler.
Yeah, it's just easier to visualize and just click the one you want instead of type it out here, which wastes a lot of time.
Mm.
And this, it's like the difference, like a second could change like your whole thing, like your whole day.
Mm. So what do most traders use?
I think just this, they just click
Yeah.
buy sell, because most traders are waiting for huge moves.
Mm.
Like they're trading like 30-minute time frames that last like 6 days. So they don't care about that. But level 2 is mainly for banks who are delivering orders to their brokers.
Mm.
Because in a bank, like the difference between 71 and 70, like that 1 point is enough. Like they make their whole business out of just that.
Mm.
And then what a person who wants to build a strategy would do is, let's open a chart. So now, like, let's just say we have a trading account and we want to learn how to trade. No, like learn how to make money. We can't. What a minute. So it's a minute-based chart. So you can't just wake up today and start entering trades and expect to make money in the future when you don't know what the past has done. So you can't just, all traders will just wake up and start hitting trades from right here and just based on nothing. Like just based on like how he feels, which is gambling. You need to actually manually go back in time all the way to the beginning of the data set, which is 50 years. Start from the hard right edge of the page and then make up a bunch of rules using indicators. So I went right click indicators, put those onto the chart. And what indicators are analysis tools that will give you some type of edge in the market. Like it'll give you some type of variable. So this indicator is called a Bollinger Band.
Mm-hmm.
What it does is it says that once it breaks out of the bands, the markets are overbought or oversold. So that means it's a reversal area. And you can see right here, it reversed. So it broke out and then it reversed back up. And then let's go to the next candle. There, it broke out and now chances are it's going to reverse up. It did, but then it came back down. So somewhere along that minute, you could have just exited.
Mm-hmm.
And then you just keep going like that. And you record that on an Excel spreadsheet. Excel. With your exact ranges. So again, it broke out of here. And then we just bought it. And let's say this was plus 2 points. We would write plus 2. And then the next one, again, was plus 2. So you broke out again of the candle. And then it went up. And then plus 2. The next one, again, plus 2. It broke out and then it moved up.
So where do you see the plus 2?
No, you're actually just writing that because you are assuming that you took that trade.
Okay.
For the purpose of creating a strategy. Or you would do it in real time. So you would, in real time, see it there, and then you'd go to that price and enter the trade, do the trade, and then record it on Excel. And then move on to the next trade one by one for the whole data set. So let's wait till it breaks out again. There, it broke out.
Yeah.
No, sorry, it didn't. It's red, so it didn't do anything. Right there, it broke out. Let's see if it goes back up. There, so you got another plus 2. And you just record it like that. -2, -2. Oh, and the reason it's 2 is just because the person makes that up.
Okay.
The person testing his strategy will make up the amount that he wants to make or lose. Eventually, you realize that 2 is the perfect amount because the market will move 2 points. Like it will go from here to here. But if you're like saying like, oh, I want to make 100, like there's a bunch of traders, I don't know if you heard, but they'll say like, oh, I make 100 points a day. And it's like the market doesn't even move 100 points a day. So those are the types of things that exist. And then you'll do that for all the data. And eventually, maybe, actually, no, you won't end up with a profitable strategy. But you'll do that for all the data. And you'll discover some type of edge. So I just added these up. And I go to line. So that's what it'll look like over time. And the more you do it and the more you add up, the more your equity curve will there. It'll just eventually look like
ups and downs.
Yeah. And then you can go test that on the live market. And that's how you make a strategy. But the average person will just open an account and start gambling based on the news and whatever else, like analysis that they've been told.
Rumors and stuff.
Yeah, but in this book, Quantitative Trading, Ernest Chen, he is a high frequency trading manager, manages billions of dollars. He will, like in his book, he outlines what I just spoke of, where like how to build a strategy, the steps, the different types of things you can try. This is a free PDF. How to identify strategies that suit you, blah, blah, all that stuff. The costs, refining, so like making the exact details of what we just talked about. Right now, we just did a simple strategy where break out of Bollinger Band, take a sell, or buy, depending on which side it hit. Like here, like this broke out and instantly reversed down. So that's like one variable you'd put in your system. And then you do that over and over. And you end up with an equity curve. And then the other book is Alchemy of Finance by George Soros. Again, another billionaire. Free PDF. He teaches is the same thing. He like teaches you in detail as to why it moves in this way and so on. But it is just what we talked about, and how to build strategies.
Okay, so on the chart,
Yeah.
go back to the chart. So green obviously is when the chart's moving up, the red is going down. And then the candles, like the line in the candles and everything, what does that mean?
Oh,
What is
so
the solid and what's just the line?
so the solid means it closed at that price, and the skinny, which is called the wick, is the distance it traveled, the full distance.
Solid means closed at the what?
Look, so you'll see right here on this candle,
Okay.
it made a high of that thing, and now it's back down here. And when it closes, that'll be wherever it closes will form the solid.
Okay.
So right now, now you're going to see it made this low, and when it moves up, there's going to be a wick.
Yeah, there's like a wick on both sides like that.
Yeah, to indicate that it went there.
And then when the time frame or whatever is done, that's what it becomes a solid at.
Yeah,
and it moves on to the next one.
Yeah, in this case, a minute. So if you look at the x-axis, it's 27, 26.
Yeah.
Yeah, there. So it closed, and now it's open here. And now you'll see it'll make a wick and a body again.
Okay.
So it depending on like it's relative to the candle before it, where the candle before it closed,
yeah,
and where it closed will determine the color of it.
Exactly. So based on the previous candle, yeah, there. So now it made this little move, and it closed there, and it'll form the new candle relative to the previous one's close.
So you see how this one went. This one has been all the way down there and all the way up there, but it closed there.
Yeah.
But where this one closed was below where this one closed.
Yeah.
So it's right.
Yeah.
But this one has also traveled this whole distance.
Yeah. And you can just see this one doing the same thing. Yeah, so this one, remember it was like just a skinny line, now it's made a high and a low. The wick is just the high and the low, and their next candle. There, now you're going to see it makes the wick again, because it went there. That's the current price. That's the current price in black. There, it made that high, and now that's the low.
Is this a live chart?
Yeah, so this is live movement.
Pounds and yen.
Yeah.
Go on.
And they all look like this. Like, let's just go to. So here's USD/JPY. Yeah, that one's not moving. Let's go to G. Yeah, this one always moves. Yeah.
Okay.
But like, do we really need to know all those RSI? And
Well, like the only thing you can like is important is just that There's 100 indicators and 104 indicators in total,
Okay.
and they're all made by mathematicians who developed patterns in the market and converted that into an indication of price movement. And none of them work to determine accurate trading. The reason for that is because they happen before the market moves. So the indicator doesn't move with the market. You have to actually manually trade and watch it live to see the real time movement. But if you just like put on an indicator and go back in time, it's not live. So therefore, you're not looking at an accurate representation. That's why at the bottom of these websites, they have this thing that says past performance is right here. Past performance, whether actual or indicated by historical tests, is no guarantee of future performance. And the average person will think that, no, sorry, a lot of people, including myself, when I first was uneducated about the legal system and life, I would say stupid things like, oh, why does this company have such a big disclaimer? It has to be a scam. It's like, no, actually what's happening is that there's a lot of laws in place in order for people who are uneducated to not make stupid choices, such as rely on past pictures for future results, as they clearly always say here. So that was that thing about indicators. Because a lot of people will get a trading account and think that indicators equals profit, or that brokers will make them money, but it's actually just for them to hallucinate.